Good morning. Futures are higher this morning as we begin another week and close out a month, the month of March. Oil slightly higher. A number of news items that are impacting the markets here at the beginning of the week. Our episode of Breakfast Club today is brought to you by the movie Groundhog Day, as we have a rally day on Monday and then hold on to your pants for the rest of the week as we probably repeat what we've seen over the last 5 weeks. Let's get into it. I'm John Hutchinson with Traders Reserve. We have a lot to share with you. Starting with all of the bad news, let's just get it out of the way. It was a difficult week last week. And I think what you should take away as you apply it to your trading is simply this: the market is no longer respecting tweets or other social media uh, diplomacy, if you will. Um, the Wall Street wants to see real movement in a de-escalation of the Iran conflict, and absent that, the price of oil will continue to rise and or fall as any progress is made or not made, as the case may be. Um, the news that basically all of the indexes are heading toward correction. Small caps are in correction, bouncing back slightly this morning. Dow in correction, bouncing back a little bit this morning. Um, the Thursday Friday was a dual story. The sell-off on Thursday and Friday was a two-part story. It was not solely that oil rose again. Um, the second part of what took place at the back half of the week were increased inflation concerns and a real major shift in market expectations, which I'll cover here in another slide. But the spike in 10-year treasuries over the last couple of weeks is becoming a serious headwind on the stock market, more so than just the price of oil. And as we exited as we hit mid-February, heading into the end of February, 10-year Treasury yields were sitting below or around 4%. They have risen by 10% in the last month. That is the bond market signaling significant headwinds and concerns. Now, that can change, but at the moment, the closer that 10-year Treasury yield gets to 4.5%, that becomes a real problem for the stock market and for stocks in general. If treasuries were pulling back a bit this morning, if they continue to pull back and or decline, that will relieve some of the pressure on stocks. That will indicate more risk on potential, but don't expect it to I don't expect it to happen in 1 or 2 days. I think you're looking at probably a 2 to 3 week cycle. And more importantly, this is big data week, as we have the jobs report released on Friday. Although the market is closed for Good Friday. ISM services will be released on Friday. And the key to both of those reports, one is, will or does the job market swing back to a positive addition from February's negative, as well as what are any of the changes to prior months. So the report from February, which I believe was minus 50 or minus 52,000, if my memory serves, did that get better? In other words, did that negative number get smaller or did that negative number get larger? So any alterations to the prior months that lean to the positive side, and along with a potential positive report from March, which I would be surprised by, but any positives on that front will give the market a better footing heading into April. The ISM services report, obviously, the most important metric to Wall Street is whether ISM services stays above the 50 level, which it did last month. But the secondary part of that is the prices paid and whether or not additional inflation pressures rise from the ISM services report. The ISM manufacturing report in February had a significant rise in prices paid, which was not expected and which we have seen through 2 consecutive months of the producer price index. So those inflation 10-year Treasury yields higher. So when I say that there are two factors that are affecting stocks right now, that's the split. You have the Iran conflict and the price of oil on one side, but you have increasing inflationary expectations on the second side, on the other side. So overall, if we can get a stable week, that would be helpful. We also have February retail sales to be released on Wednesday. That will be key to show us whether or not the consumer has been holding up. As we go into yet another week, we are now in the middle case of the Iran conflict scenario, with oil essentially between, let's separate this. Brent crude oil essentially sitting between 110 and 120 a barrel, versus West Texas cruise, which is sitting right around $100 a barrel. That's common, but unless or until there is any alleviation of the issues with the Strait of Hormuz, oil is going to stay up. So a prolonged stalemate, which is what we have right now. We have a stalemate. How that stalemate is broken determines whether we move to a diplomatic resolution or an escalation of what's taking place in the Middle East. And preferably, let's lean toward the diplomatic side, right? That would alleviate at least some of the inflationary pressures and get oil moving again. And one of the things not really getting enough attention is the one country that is heavily dependent on oil is China. And at some point, I have to believe that even if it's through diplomatic back channels, China is going to speak up at some point, because there are issues that are happening across Asia, Asia and the Pacific, and the Eastern Pacific, that are negatively impacting economies. That starts to roll out to a global problem. Goldman Sachs recently increased the risk of recession to 30%. Others have increased it to 50%. But the biggest issue, which took place late last week on Friday, and the reason the markets fell off so heavily on Friday, is because market watchers, essentially the Fed watchers, repriced in a rate hike versus rate cut. And that rate hike increase by the end of the year jumped to 50%. That is certainly not priced into the market, not even at recent levels, and even not even at current levels. The market was still hoping for rate cuts at some point, even if those rate cuts were pushed out to September or October. Now, keep in mind that the mention of rate hikes is a sell the news event. No Fed speaker on the Fed speaking circuit last week said anything close to or related to rate hikes. In addition, you're also probably hear, or you will hear, more talk about stagflationary risks rising. But Jerome Powell was very clear that the stagflation of the 1970s is nothing at all like we're seeing today. The issues that lead to stagflation. So where the Fed is essentially saying the risks are balanced between labor and inflation, or has been saying that, they are not. The Fed is not saying rate hikes are on the table, and part of what this is creating is a divergence, right? What the Fed is saying versus what Wall Street is trying to price in. And Wall Street always prices in the worst case scenario, which is what happened on Friday. And it's largely why stocks fell so heavily between Thursday and Friday, along with the continued upward pressure in the price of oil, the rise in the dollar, the US dollar sitting right around the 100 mark. That creates inflationary pressures. We also saw late last week, sorry for the data dump, but it's important, import and export prices rising substantially to levels not seen since 2022. So there is a significant increase in the inflationary pressures, which is what led the market to price in the higher probability of a rate hike versus a rate cut. And we have another Fed meeting later in April. So at least we'll get some resolution to the Fed's view on interest rates for the, call it the middle of the meetings. Remember that the key meetings, the rate policy meetings, are March, June, September, December. So the middle meetings are essentially clarifications of current policy positioning. And as well, we have to keep in mind that Powell's term was expected to end between April and May, but the new Fed chairman that has been nominated by President Trump, Kevin Warsh, still has not been confirmed. He hasn't even had a hearing yet. So whether or not that resolves by the end of April, I don't think that will negatively impact the market at the moment. I mean, if Powell says, I'll just continue on until I'm replaced, I think the market will view that as a general positive simply for continuity. But there are some issues that we have to keep our eye on. April also gets us back into Q1 earnings now, coming up in the next 10 days, as banks and big banks especially begin reporting, I believe the second full week in April. So we have news coming, and that can help, it can hurt, but we will have to wait and see. The big thing that I want to take just 2 minutes on, and I am still doing some analysis on this, were the double defeats for Google and Meta, Facebook, in courts last week. And the media conflating those court losses to artificial intelligence. What the headlines said essentially was that artificial intelligence is not taking the risks of harm to people using AI seriously, and the way the media conflated that was using research from Google and from Meta, then Facebook, that dated back 10 to 15 years, and that's what led to those court losses. Inevitably, they'll be appealed, I would expect. But essentially, the media continues to frame anything it can negatively as it relates to artificial intelligence, when what actually happened was these were product design liability lawsuits. That is to say that the algorithms that were used by Facebook to target posts toward users were what led to the harm, not the user using Facebook in and of itself, or social media, so to speak. The second thing is there have been very loud and consistent voices in artificial intelligence warning about not the risks of harm, because it's a really weird way to say it, but that there are still challenges facing artificial intelligence. But again, we need to keep a separation, a very clear wall between business transformation and consumer transformation. That is how businesses use artificial intelligence to assess data, to acquire customers, to use customer support agents, so to speak, right? Anything that is business transformation is not, I don't see the leap to consumer harm. Businesses that acquire massive amounts of data or have massive amounts of data which need to be analyzed internally, is not the same as an algorithm on social media dictating which posts you see. Could it be used that way? Sure. Is it being used that way? Not at the present time. Doesn't mean that it won't be used that way. I have to qualify that statement. But the way that the media positioned this was this big negative for artificial intelligence. That happening late last week was a third leg which kicked out from underneath a wide swath of artificial intelligence stocks. But it does not change the fact that artificial intelligence is still, to me, a business transformation, not a consumer one at the present time. So this, again, continues to bear deeper assessment. What are the risks, if there are any real risks, to artificial intelligence? So I'm not there yet. But questions for this week: can the market find a bottom? This really is where we are today. It's another Monday with the markets up. That has been the pattern for the last several weeks. Be cautious about buying into that pattern. Uh, we didn't have any pre-market tweets that I know of yet today, so that helps to a degree, meaning any movement higher in the market is organic. It's not happening because it's not being news driven. And I would prefer to see that stability in the markets being organic and not news driven. When they're news driven, if it's positive news, the markets will bounce back strong. If it's negative, likely fall again. As long as oil remains in, call it a wide range, but between the 100 and 115 levels, the market will begin to reprice how that affects stocks in the economy. In other words, the market will learn, Wall Street will learn to live with higher priced oil temporarily. Uh, because Wall Street knows that at some point this conflict will end. When it ends, oil will fall, and they can then reprice to the future based on that action. Uh, Yields again were declining to start the week as the 10-year Treasury prices were higher, so yields are falling. That's good news. Any pullback below the 4.4% level will also alleviate some pressure on stocks, but it won't be 100%. It's not going to move the market substantially right away. But if we continue to see yields pull back, that will be a positive sign. And then the last thing we just need to watch for is whether or not there are any language shifts from the Federal Reserve speakers over the next 2 to 3 weeks, not just in this one particular week or this specific week, but each of the next several weeks. And I think your Fed speakers will stay on point with the price of oil will have an impact. They can't measure it because it may be short term, it may be medium term. It's an unknown, it's a known unknown. But what the Fed is largely concerned with remains the labor market. Labor was stable last week. Weekly jobless claims remain low. And we're still in the same no hire, no fire market we've been stuck in for the last 8 to 10 months. So nothing critical has changed on the labor front, even though the labor market printed negative jobs last month. We'll see what happens. Excuse me, negative jobs for February in the March report. We'll see what happened in March when that report is released later this week. So the underlying for the week. My chart failed. Sorry about that. Main thing that I was watching, was there any significant negative? This is called an invisible chart. You can make up your own stock names and imagine whether those stocks were higher or lower. But for the moment, one of the things that I discovered in looking through the 300 plus stocks that I track in the AI index is that there were still positives in the week, even though the week overall was negative. But the AI solutions, which is largely the software arena, continues to be negatively impacted. That is ongoing since the beginning of February with the release of Claude Cowork. That has not changed, but the supply chain continues to, even though many stocks in the supply chain took a hit last week, no question about that. But many of them, most of those stocks, especially those in our portfolio in AI2, also held key levels and are bouncing off of those key levels as we begin the week this week. So still some positives if you can look for them. It's the lipstick on the pig. Let's be clear about that. But if you are able to find good stocks with good fundamental cases, those stocks will recover, and they will recover faster than the general market. We saw that last week in the early part of the week. It didn't hold in the latter half of the week in our AI2 portfolio. We're beginning again today on a swing up. And again, we'll see how that plays out through the remainder of the week. I talked about China, and I'll spend just a couple of minutes here. as we'll recap this later by email. But the biggest issue here is China gets 75% of its oil from the Strait of Hormuz through the Strait. So that has a negative impact on China's ability to build out data centers, build out and compete on the AI front, build out their economy. We're already hearing about gas shortages throughout Vietnam and other countries in the Asia Pacific realm. So that's a global economy negative. But one of the under discussed angles here, and CNBC actually had a small story on quantum computing today. Don't rush out and buy quantum computing stocks just because of that story. But where edge and quantum have an advantage in the future is a significant reduction in the power requirements, expected significant reductions. That means less oil to power the energy necessary or needed for the computing power required for artificial intelligence. So in the supply chain arena, again, those companies which support edge computing and quantum computing have the potential to get a little bit of a tailwind in the weeks to months ahead. That has to play out. It still need to validate fundamentally whether that's the case. But if you're hunting for stock ideas where you may be able to pick stocks off of recent lows, that is an area that I would be looking at. Anything in supply chain, edge computing, and even in quantum computing. So still watching this week, price of oil, Strait of Hormuz, any diplomatic resolution or any path toward a diplomatic resolution will give the market a stronger floor to begin building up from. Again, keep your eye on that 10-year yield. If it continues to pull back from the 4.4 to 4.4% level, that will be a positive for the markets, as well as Fed speakers not invoking anything related to rate hikes. Micron continues to be a long-term stock worth holding, even though it has suffered a pretty significant drop from recent highs. The company's 2026 HBM3, HBM4 all sold out, now moving to long-term contracts to guarantee memory supply. There were a number of negative headlines in the memory markets, which negatively have impacted Western Digital, Seagate Technology, Micron, SanDisk, sort of my core four in the memory and storage markets. Give those headlines time to play out. Those are, again, sell the news fronts. It does not negate the memory, and again, it does not account for future growth in the memory and storage markets. Finally, there was a Taiwan semiconductor deal, a massive investment for Taiwanese firms for U.S. fabrication build-out. This is a long-term structural driver behind a number of that supports a number of companies. It's not new news, but the market is still pricing it in. And as long as that is not negatively impacted by what's taking place in the Middle East, that is, as it affects the ability for these companies to bring production to the United States, you're going to see a continued lift in semiconductor materials and equipment, the offshoots of artificial intelligence in the supply chain. So this is an area, again, that I have on my list as exploration and analysis and assessment, and which companies have the potential to profit from those realms. And then finally, obviously the rate hike risk, CME, FedWatch now pricing in a 50% December rate hike probability. But again, that is the absolute opposite of Fed language. And the Fed dot plot still showed one rate cut likely in the fourth quarter this year. So we have a very wide view diverging there. So that bears watching as we go through the month of April, but I don't believe you'll see true resolution on that until the Iran conflict ends in some fashion. Number one, economic data and inflation data stabilize, number two. And number three, the Fed meeting in June, where they set the next rate policy expectations forward. And sort of a 3B is what happens with the Fed chairmanship, whether Powell is forced to, I say forced, but agrees to continue on as Fed chair absent the confirmation hearings for Kevin Warsh. So again, I would be low and slow this week. Keep your exposure low, keep it slow. Do not be surprised if we continue to see the Groundhog Day effect of an up day Monday, but then a slow decline through Thursday of this week. A reminder: markets are closed this Friday for the Good Friday holiday, and then Easter Sunday. Happy Easter in advance to you. Outside of that, hopefully we can find some Easter eggs and maybe some Easter candy in this week's market. But stabilization is the most important thing. If the markets will stabilize, hold specific levels right now, heading into earnings season, then I think we will begin to see some improvement in the overall markets, but it's going to take time and patience. So hopefully you have both of those, but if not, do the best you can, keep your capital to the sidelines where necessary. Don't be afraid to make trades in a market environment like this, but do be willing to reduce your exposure. If you normally sell 10 contracts of an options trade, sell 2 or 4, right? Reduce your risk exposure by pulling back the capital that you put in the market or at play. And that will at least keep some of your risk capital safe. Risk and safe don't go together in the same sentence. I realize that, but the capital that you are willing to risk in the market, if you decrease it, you protect more of your capital for when market is stable and when markets are more rising or more bullish. So that's your Breakfast Club for today. Good luck with your trading this week. And for those of you in AI2 Insiders, I'll see you at 4 o'clock with a deep dive on everything taking place in our portfolio and some opportunities that are coming up for us. So have a great day. And I'll have the recording up here in just a few minutes.